Today, basically, I want to go over, we won't have much to talk. I just want to talk actually about one thing, and it's the FOMC. So, and the rate cut, will this continue or will this stop? How is this going to progress onwards? The key decision from the December 2024 meeting, and the second is the economic projections, because we did have some changes on the economic projections, especially for the target rate. Okay, so especially for the target rate for 2025 and 2026. So this is going to be pretty much the two topics we're going to be looking to talk today. But before we go any further, guys, I just want to go into the risk disclaimer. I'm going to give a minute to everyone, and then we should start after that. All right, I think that's enough. So let me just get out of this. And so basically, I want to start to go into the Federal Open Market Committee, and so into the Fed website. I'm going to send the link into the chat. There we go. Fed website. So you guys can have access to it as well. Done. So it's on the chat. The Federal Bank website. You're gonna get on this page. So if you scroll down all the way to December, that's where we want to go, and then click on HTML, and this page will open. Or if you want, of course, you can download it. You can download meeting by meeting, but it's not necessarily needed, because you can always come back to the website and they're always going to be there. It's something that we would take off. So you can definitely get on the HTML. Okay, what is the implementation note? All right, okay, we don't need that. Anyway, so basically just a press release into this statement, HTML. Okay, so the Federal Reserve, as everyone knows, it operates under a dual mandate. Basically, it's to promote maximum employment and to ensure the price stability into the economy, which basically translates to keeping inflation around 2% target, and with lower rates. These two goals, they often interact in a very complex way, as we're seeing right now. So over the past year, the labor market has shown some signs of softening, which, with the unemployment ticking up slightly, but still remaining low according to the Fed. Okay. The inflation, on the other hand, has been very persistent challenge. As we saw some progress towards the 2% inflation target, but it remains somewhat elevated. And the dual mandate shapes pretty much all the decisions around, shapes everything what the Fed do in terms of decisions. Okay, so when the economy grows too quickly, maybe the Fed will tighten the monetary policy to cool things down. Or if the opposite happens, if the growth is low too much, then the Fed may ease the policy to, make some more activity into the economy. So basically, this is how a central bank works. Not only the Fed, it's a central bank work. Okay, and this is the press release. So this is pretty much the first thing that always gets out on the release, and it states to us very briefly about the economy and very short what they've done. So first one, it says that recent indicators suggest that economic activity has continued to expand at a solid pace. Yes, we've seen that. Since earlier in the year, labor market conditions have generally eased and the unemployment rate has moved up, but remains somewhat low. Inflation has made progress towards the committed 2% objective, but remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run, and the committee judges that the risks to achieving this employment and inflation goals are roughly in balance. The economic outlook is uncertain, and the committee is attentive to the risks both sides in its dual mandate. On support of these goals, the committee is dedicated to lower the target rate for the federal funds rate by 1/4 percentage point to fourth 1/4 to fourth 1/2. Okay, so basically 4.25 to 4.5. Okay. In considering the context and timing of additional adjustments to the target range of the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue to reducing its holding of treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate instance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the instance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee goals. The committee's assessments will take into account a wide range of information. Then this basically is, it's very important. It's not the most important part, but it's one of the most important parts that we need to always have a look at it. Okay, so basically, for the next meetings, what is the Fed looking? And that's exactly what they say here. So basically, they're saying they will be looking at the labor market condition, the inflation pressures, and as well, of course, the inflation expectations and the financial and international developments. Not only them, they're not only looking at USA, but they're looking at the whole global international development. If the world goes crazy, if something happens, if I don't know, something geopolitical, something very unstable happens, then most likely that they will assess that in international developments as well. Okay. And then just here, the voting chairs, we don't need to know. But basically, yeah, this is really important, but this gives us an overall field. Okay, this gives us the first hint of what they will be talking. Sorry, just drinking some water. I'm not feeling very well. Sorry for my very low voice. Hopefully you guys can hear me well. Okay, now, as I say, in December, the Federal Open Market Committee, they lower the rates, the target range for the federal fund rates by 25 basis points, now trading at 4.25% to 4.5%. And this move somewhat signals the shift in the Fed approach. They basically trying to balance the risks of this slowing growth with the need to continue progress of inflation. And the Fed funds rate is influenced, it will influence the borrowing costs across the economy, from mortgages, car loans, business investments, all of those things. But lowering rates can somewhat stimulate economic activity by making the borrowing cheaper. Not in scenarios as we are right now with inflation high, borrowing costs can skew to the upside, but in a overall look, yes, it can somewhat stimulate, okay? It will basically stimulate economic activity, all right? Not stimulate let's get a loan or something like that. No, but it will stimulate economic activity, making the borrowing cheap. And also it comes with risks, particularly if inflation expectations start to rise again. And that's one point we're going to touch base on later. The Fed has emphasized that any further rate adjustments will depend on incoming data and as well the evolving economic outlook. This leads us to basically the Fed strategy for managing its balance sheet. What I think it can potentially happen is they won't cut aggressively as they would before, because Jerome Paul, he was giving a speech, after it. So after the release of the press release, as well as the rate decision, they have the monetary policy committee. Okay, so basically it's a speech from the chairman, in this case the Fed, is Jerome Paul, but I basically say this was a closed call. What does he mean by a closed call? Basically, is that they've talked a lot. They've come up with a lot of talking in all of those members here: Jerome Paul, John, the Vice Chair, Thomas, Barkin, Michelle, Raphael, Michele, Lisa, all of those people here, they voted into, somewhat maintain as well. So basically, voting to the monetary policy action. So basically, these people here. So 1, 2, 3, 4, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So 13 people voted to cut 25 base points cut. And then we can see that voting against the action was one person. So yes, one person actually talked about maintaining the target range as it is. So we still have some sort of, because yes, in the end, 13 people voted to be a 25 base points cut, but one person is still thinking that is smarter, let's say, to maintain the rates as unchanged. Now, I don't know if you guys remember, but I've talked about the CME Fed Watch 2 for the whole next year, and we could see that they were predicting, I think, 75 to 100 basis points cut for next year. Well, now things are a little bit different, okay? So starting off for January, okay, so 29th of January, it's going to be the first meeting of the Fed, and they're already predicting, well, 91.4% of the market participants are predicting a pause. So no cut, no change. On the 19th, again, 57% is expecting a pause. So that's pretty much the whole quarter, right? January, February, March. And then we go May. Again, 48% is predicting a pause. And then we go June. And then we have a 25 base points cut. Then July. Is it not going? There you go. Again, no changes on July. And then September, no changes on September. And then October, no changes on October. And then December, no changes on December. So basically, they're predicting one cut only in May. Okay. So not even in May. Is it on June? Yeah, it's in June. So they're predicting a cut on June. So first quarter, no cuts. Second quarter, we may have a cut. Why is that? Well, let me show you. So if we come here and we go into the other side onto the press conference right here, we can actually have a look at what he said. Let me share my screen again with audio. Share sound. Perfect.
Good afternoon. My colleagues and I remain
let me just put where he starts to talk.
Restraint more slowly. If the labor market, everything we do details on why. Downside risk.
Okay, it was on her question. So
Cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. But 12-month inflation has actually been moved.
I think it's not quite there.
Further adjustments. You ask about 2025. As higher to be appropriate, as long as the economy and the labor market. So this does seem of cuts for next year really reflects, and the expectation with the extent and time.
There you go. So he's going to talk about the expectations about next year cut. So let's just pay attention on what he says.
Timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments.
There we go. So they are nearly all in the pace of lowering. Basically, what was happening is every meeting since 3 months ago, they were cutting. Every meeting they were cutting 25 basis points. So basically, they've cut 100 basis points in 4 to 5 months. Okay, and now they're on a commodity pace that they don't have to rush the cut rates anymore. So basically translating what he's basically saying to a basic simple terms is we are where we wanted to be, and now we don't need to be rushing to cut the interest rates anymore, but has more to say.
You ask about 2025.
Now,
I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up.
And then this quick follow-up that she's going to do is really important as well. She's going to ask about, do you think you're going to continue to cut or something like that? So let's have a look on this one.
Follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way. We've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
There you go. See, 2 cuts next year compared to 4 cuts that they had in September. So let's just do this bit again.
Cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
So that's it. Okay, so that's very important. I thought it was worth to show everyone. Now, what is even more important is that if we go to the projections material and then come to HTML again, I can send this link to everyone so you don't have to be looking around. Projection link. Zordo says, so yeah, next year I also don't think that we'll cut the first quarter, even second one. Look, what I'm expecting is kind of in line. Okay, so we may have a very strong US dollar for the whole first quarter now. I was expecting, some people was expecting to be, I think even Zodwa or someone here Tuesday said that, first half will be strong and second half will be weak. I don't think so. I don't think we're going to have a more mixture way of the trading and the US dollar. And we should be having exposure in some other assets as well, not only Forex. We should have some exposure on stocks as well. Maybe even equities. I think it would be really great, like S&P 500 would be such a good hold on the portfolio. I think to constructing a portfolio would be much more helpful than only trying to trade on the one side market. Being somewhat in a good sense, I think will be pretty good. Okay, so yes, that's what I expect. I think US dollar will be quite strong coming into 2025, fading off into June and July, and then September, October, and November, December. All right. Now, what is really important is the economic projections, right? So the latest economic projections that we had at the moment, it provide a window of how the policymakers are viewing the economy trajectory. And for the GDP growth, the median projection for 2024 was 2.5%, with a gradual slowdown expected in the following 25, 26, 27, etc. So it pretty much aligns with the Fed long-term view that the growth will converge around 1.8% annually, from falling down to 2.5 all the way to 1.8% on the longer run. But unemployment is projected to be somewhat, not, I wouldn't say stable, but stabilized at 4.2% over the longer run, and slightly above the current rates that we're having at the moment. Pretty much reflects that expectation that the labor market will remain resilient, but not overheated, sorry. And I think the most important is the actual inflation, right? The inflation forecast to decline towards the 2% target is what everyone wants to know. As well with the core PC inflation, excluding food and energy, is expected to drop to 2% until 2027, as we can see on the table. But again, those projections pretty much shows how the Fed is very confident in achieving a soft landing, and where inflation is controlled without a significant spike in unemployment. However, I think there are risks, and risks remain very, we should remain very attentive to the risks, particularly from the global economic developments and the financial market in China, as well as the commodity. But in a whole nutshell, I think, yes, this sounds quite good. The other point that we need to touch base is the quantitative tightening. I forgot to talk about that, but in addition to the rate changes, the Fed will continue its policy of QT, so quantitative tightening, basically involving, reducing its holdings of treasury securities and the MBS, so mortgage-backed securities. But lots of people don't know why this matters a lot. Lots of people think, oh, okay, it's just QT and MBS, just reducing the MBS, reducing the treasury securities. Why does this matter? Well, when the Fed basically reduces its balance sheet, it can have an upward effect on the longer term interest rate. So even as short term rates are adjusted, this is very important. Okay, so in another level, the Fed uses the quantitative tightening to influence the economic conditions without relying solely on the rates. Okay, so only rates wouldn't be sufficient. They need something else. And this is why they have quantitative tightening and quantitative easing. Quantitative tightening when they are tightening the rates, and quantitative easing when they are easing the rates. Okay, it's basically a combination of rate adjustment and the balance sheet reduction, reflecting the Fed goals to bring inflation down, maximizing employment, and minimizing unemployment. However, as I say, they have to work in a combination, a very Swiss watch. We have Swiss watches. They are the most perfect watches. Okay, if we go in images, let me machine, like right here. Let me grab one that shows better. Oh, this one, perfect. So you see all of these wheels here in gold color. They are the what it makes, like it goes to this one and then builds this one and that one, this one, and all of this work in combination to basically show three things: hours, seconds, and minutes. So it's just, it's just the best of the best. And this is exactly what happens. So we have the rate. Sorry, I'll come back here. We have the rate reducing or easing the rate. We have quantitative tightening and we have quantitative easing. So basically minutes, hours, and seconds from a Swiss watch. All right? So that's what it's so important to have all of those three things in hand. So yeah, that being said, I think we have to assess all of that into what is the implication for the market and the economy. Well, we have pretty much four things, four dot points that I would like to say. So first, for the financial market is basically lower interest rates will definitely provide a tailwind for equities, especially sectors like technology and real estate. And on the flip side, if the fixed income investors may need to reassess the strategies because the yields will adjust. For business, basically cheaper borrowing costs will encourage the investments, but business will remain cautious because it's a very uncertain economic outlook at the moment. For households, lower mortgage rates and credit costs can boost spending, but inflation still poses challenges for household budgets. And fourth, but not least, is the global economy. So the Fed decision have, ripple effects worldwide. So it would basically influence the currency market, capital flows, economic conditions in all other countries, not only from USA. Okay, so when we talk about that, when we talk about the Fed, we're talking pretty much about a organism that controls the whole world. So it's insane how it's so powerful. Now the question that comes to mind is, Luca, didn't you tell me from the very beginning that when a central bank increases rates is good, when a central bank cuts rates is bad for the currency? So basically, bullish and bearish for the currency. Well, yes, but depends the actual understanding of the market participants. Okay, so let's have a look at the US dollar index first of all. Look at that. Okay, I've mentioned about it that the potential for this US dollar index to go above the 108 that was before is huge. Okay, and that we could potentially be looking at a round bound trading scenario. Okay, and that's exactly what we're having. Okay, so yes, why did the market actually react bullish to the US dollar? The whole answer is because of the rhetoric, the forward guidance that the Jerome Powell have said, that they are not predicting 4 cuts for next year anymore. They're predicting 2 cuts for next year. So showing that the market was predicting something very bearish and now is predicting 50% bearish. It's basically telling us that the market can be bullish because last month, 2 months ago, we had a prediction of 100 basis points cut for next year. And at the moment, we have 25 to 50 maximum. And that's exactly what, as well, Jerome Powell said. Jerome Powell basically stated that now they don't have to rush to cut the rates. They can cut the rates when they feel like it needs to be cut. So this translates into a very bullish scenario for the US dollar because investors feel like that the yields will continue to go higher. And as we see, the 10 years and the 2 years yield, the long and short-term bonds, it is trading at 4.5 4.552 at the moment. And for the 2 years, for the short term, it's trading 434. So, you know, it's still somewhat reliable to have some money parked on US, in my opinion. So, especially with weaker currencies like Japanese yen, I think the carry trade can probably continue to go for USD JPY, especially after the monetary policy released by the Japanese bank today, the Bank of Japan. You know, one thing I was actually trying to understand a little bit more about the culture of US from Japan is that being a negative interest rates policy and NIP is pretty tricky. You know, it sounds pretty good, but what is the actual money that the banks make and etc.? Well, they don't. So basically, they charge a lot of money for households, and households are not prepared for higher rates. So Japan, Bank of Japan knows that, and this can potentially weaken the Japanese yen, giving some carry trade for the USD JPY 170. Okay, so that's my opinion for today, guys. Hope everyone could understand some of the topics. And yeah, 2025 is just around the corner. Hope everyone had a beautiful year. 2024 could learn a lot. But yeah, that's pretty much it. Any questions? No questions? If you learn a lot, you know what you could do, Sweets? That would help me a lot. You could use the Trustpilot to make a review under my name for ACY securities. Here's this one. You can make a review for me. And that would be good. Thank you. Awesome. Thanks, Lodwa. Yeah, if you guys can do that, that would be really great. If I really think it's worth. But yeah, thank you so much, guys. Yeah, you can keep doing that every week. Thanks, Fritz. So what's your projection on Euro dollar? My projection on Euro dollar, I'm short, right? As I say on Tuesday. Oh, this is not working. Damn it. Okay, let's go use TradingView. So I most likely will be short until next year. I think we have a potential to break down this area and continue to basically 1,000. So I will be looking to continue to short the market into pullback into Euro dollar. No, I don't think so. In my opinion, I think this is a pretty solid move. You know, and yeah, so it broke down here, these bottoms, and has all of these area here to continue to run, and most likely we will see this continuation downwards. Okay, guys, thank you so much. Again, don't forget to do the review on Trustpilot. I really appreciate that. Hope you guys have a beautiful weekend. And then I see you go, oh, actually, this is it. This is the last one. So I won't be here until I'm coming back. I'm going to come back on let me see, I think it's the 16 or something. 14, I think. I'm coming back on the 14th of January, guys. Thank you. Have a great weekend, and I see you when I come back. Cheers. Thank you. Bye-bye.